Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about some things you can expect when you start investing in stocks. You've saved your money, good job, and now you want to learn how to invest or make your first investment. So investing isn't about jumping in just sort of wherever you feel like it with your money. It's not about saving more to jump in with. It's about finding something that you love and understand to buy and hold. Really important points that you get this, because remember, Warren Buffett says risk comes from not knowing what you're doing. So knowing these 5 things are going to help better prepare you and reduce your risk. So first thing, you can expect to reduce taxable income, which is awesome. So in order to start investing, you need to open up a trading account. And one of the most common options is called an IRA account, individual retirement account, which also doubles as a retirement fund. So when you have an IRA account, especially a Roth IRA account, you save for retirement with tax-free and tax-deferred dollars. Now, let me explain real quickly. The money placed in a Roth IRA is taxed up front. In other words, before you put it in there. But once you put it in, it grows tax-free and you never pay taxes on it. So that's really awesome. So neither your contributions nor the earnings are taxed when you withdraw it at retirement. So the Roth is a fabulous opportunity to invest if you're in a low tax bracket, okay? Now, if you're in a regular tax bracket, then the IRA is the best thing to do because you're taxed. You're not taxed on the dollars you put into the IRA, and they grow tax-free, but you're taxed when you take it out. Now, another thing you can expect in investing is to get emotional. All right. Now, this is a huge challenge because investing is full of ups and downs and highs and lows, and it can feel amazing when your stocks go up, and it can be downright scary when the market fluctuates downward. And what we do is we try to use our emotions to find businesses that we love, right? We feel good about them, and we care about those companies existing in the future because they match our values, because it's really important that Rule 1 investors act in their own best interest. So if we want to see something that grows into the future, a business that we love, that's the kind of business we want to buy. So we want to act rationally with our money. And this is kind of what sets us apart from fund managers and other investors. It's kind of the ability to stay calm when others are panicking. I know that sounds really crazy, right? Because we're talking about fund managers. They're professionals. Surely they stay calm. But the fact of the matter is that they don't control their capital. We do. So we can actually use other investors' fears, particularly professional investors' fears of having their capital taken away if they don't keep up with the people they're competing with their peer group, on a quarter-to-quarter basis. If they don't keep up with it, that money goes away, they get fired. And that's a tremendous emotional pressure on these people to constantly be moving that money around. And so if something starts going down and they start to be afraid that this is going to hurt them compared to their peer group, they're going to exit because they think everybody else is selling as well. If we're sitting there with cash, we're going to be able to buy when they panic out of something really good. And that's the basic fundamental premise of Rule 1 investing. We think long-term, and we do not panic over these short-term fluctuations in the market. We use them to benefit. Warren Buffett says, when you have these fluctuations that are occurring, it's like it's going to be raining out. So I said, like it's an economic storm that's occurring either to this company or to the industry it's in, or even to the market as a whole. You have this economic storm. He says that economic storm is raining gold. And you want to go outside when it's raining gold with a wash bucket, not with a thimble. So we're not going to be prepared, we're not going to panic about short-term fluctuations. We're going to be prepared with a wash tub to go out and take advantage of those things, because we know we want to own wonderful businesses when they are on sale. And it's those economic fluctuations, it's that fear in the market that put those things on sale. Now, because of that, you can expect that investing is going to take time. In other words, we buy businesses with the intention of keeping them for a long time. We also wait a long time for those economic storms. So we do research on wonderful businesses that we predict are going to be around for the next 20 years. So it's important to remember, you guys, that this is not going to happen all, like all at once or overnight. I mean, we all want it to, of course, right? We need the money, we have pressure. But rule one investors, we think long term. And we think long term because we're willing to put the work in now so that we can enjoy the fruit of that retirement down the road. So that being said, there are going to be times when you can expect to sell, all right? You're not going to buy and hold everything forever. So while the best time to sell is never, that's when we want to sell, never, because we found such a wonderful business, right? But there are situations where we may want to sell off the investment. Now, the times when we want to sell include when we need money for our cost of living during retirement, right? We might want to sell something then when we got to have capital. When your wonderful business investment is no longer wonderful, we say when the story changes, right? The company starts to change something. We got to remember, companies are failing at a faster rate than ever before in history. Companies used to last 50, 60 years on average, public companies. Now they're lasting 15 years before they're acquired or they go down or whatever. So that's the next time we want to sell, when they're no longer wonderful. And also we'll sell when the business that we love gets priced so far above its real value, we're going to sell it then. If it gets crazy priced, then we can buy it back later on. And then finally, when the market has a big downturn, then we may sell off some of the portfolio that is already near the sticker, near its real value. And that way, we're able to take that cash and buy back into these companies when they go down. Last thing, you got to expect to have fun doing this. Learning how to invest and understanding what you're investing in, this can actually be really enjoyable. It's not something that's like, oh my gosh, this is work, this is hard to do. What's a blast is that you're going to learn to invest and you're no longer going to be afraid or confused or stressed out about what's going on in the market. You're going to know what's going on in the market. You're going to know what's going on with those businesses you own. And if you invest in this Rule 1 style, I promise you, you're going to look forward to checking on your stocks, watching your savings grow. It's really fun. There's not a lot to do once you pick them. The work goes in up front. And I'll tell you, the most important thing that we do in terms of long-term investing is wait patiently for that economic storm. Now listen, I'd love to hear from you guys. Are you prepared to invest in the right way? Right? Can you do it? So leave a comment below with your answer and I'll be sure and follow up with you. And thanks for watching, you guys. Now go play. And if you enjoyed this video and you think it was valuable in teaching you more about investing, hey, subscribe to my channel and share this video with your friends. This is great stuff. And anybody who might benefit from this thing, share it with them all, you guys.